Hello, everybody. So thank you all for being here. Gotta make this bigger. There we go. JD says, I'm seeing the Yesterday movie. What is that? Never heard of the Yesterday movie. It's I'm gonna do this. Gotta get my hand up there. Hey, Rob, man, Rob, I just watched that video on that Trump hater, Economist that you sent to me. It's I don't get it, man. These economists look, I don't care if you like Trump or hate, I don't care. The idea is you can make any Tracy, Houston, you can make any economic activity look good, bad, or ugly. It's weird, just these guys. It's just strange to me. But he did say something of interest. I'll tell you, folks. Can you all hear me? First and foremost, thumbs up if you will. He said, let me just make sure I can be heard. Oh, and speaking of which, while I'm yapping here too, a lot of times the comments get in front of me right on. And so if someone's acting stupid, just saying stupid stuff. I don't know, some guys, whatever. Some people say stupid stuff. I guess I don't know how you'd let me know. Actually, let me know somehow, because it looks like I'm a little bit behind the comment section, or the some guys act stupid, and the comments are below from where I'm talking, and so I can't right on, Clint, Tom, so I can't see if someone's being dumb sometimes. Anyway, so this economist was sitting there saying that he thinks the Fed's going to cut 3 times, and I have no clue, no idea whatsoever. But the interesting thing is that this kind of goes back to the issue that interest rates have to go up, or that the dollar is going to be Houston, right on. Another Houston guy. So we got 2 people from Houston, Rich and Daniel. Right on, Daniel. If you look at negative interest rates in Japan and Germany, interest rates do not have to go up. It's all there is to it. And negative interest rates, or even low interest rates, do not equate to inflation, mass inflation. It's just the whole economic school of the past, where it said high employment, low unemployment, low interest rates inherently lead to inflation. There's no evidence of that anymore. Now, people can say it's because of the Fed. People say whatever they want. If you think the Fed has that much power, I don't know what to say. I just don't believe it at all. The idea that a couple technocrats in Washington, D.C., or New York, wherever the hell they are, can control the state of the world economy, I just don't believe for 2 seconds. I don't believe in an top-down command control approach. I believe in bottom-up individual liberty approach. So anyway, the whole point was this guy was sitting there saying the Fed is doing this, they're doing that, they're doing this, they're doing that, and basically as if they can control everything. I don't. All right, so I'm going to start with something. Longview, Texas, right on, Monty, right on. How's the better half, sir? And then we got Dave from Utah. All right. Los Angeles, Jordan, Carrie from Birmingham, right on. Remember the Birmingham Iron? The AAF, man. I love that league, and they screwed it up. Dustin, right on. USMC, where everything wants everyone for free. Madison, Wisconsin. Richard in the house, right on. We got Tennessee here. Jeff is present from North Carolina, right on. Bruce from New York. All right. I want to share just a real briefly, Augusta, Cheryl. This is called Principles Economics from a guy named Carl Menger, German, Washington, Kentucky. No idea where that is, Kenny, but Arlene, I know I've asked you before, I just can't recall. Where in Maryland are you from? We got Chicago. I'm going to share with you just a real quick. So remember, we had Karl Marx. Yeah, I'm going to talk about that, Robert. Who's a German economist back in the 1800s. And here we got Carl Menger, who wrote in 1840. And he was born in 1840 and he died in 1921. It's just ironic that we don't know anything about old Carl, but we do know about Marx. I just want to share with you something here, because I think it's critical. If you're looking for a book on economics, I'm telling you, Adam Smith's book's great, but this book, Principle of Economics by Carl Menger, is without question, in my opinion, the fundamental treatise. That and Ludwig von Mises' Human Action. You got to get them both. Shenandoah Valley, Virginia. Where's that, Kevin? I lived in Dayton, Virginia for many years. 3 of my 4 were born there. South Dakota. All right. Rob in the house. Go Bees. All right. So I'm going to read something real quick, especially in this day and age of, like my man, someone was saying there, who was that saying in Southern California, everything wants everything for free. If the quantitative relationship under discussion occurs in a society in accordance if a quantitative relationship under discussion occurs in a society, that is, if the requirements of a society are for a good are larger than the available quantity. The requirements of a society for a good are larger than what's available in the economy. Does that sound like healthcare? It is impossible for the respective needs of all individuals composing the society to be completely satisfied. On the contrary, nothing is more certain than the needs of some members of this society will be satisfied either not at all or at any rate only in incomplete fashion. Here, human self-interest finds an incentive to make itself felt. And where the available quantity does not suffice for all, every individual will attempt to secure his own requirements as completely as possible to the exclusion of others. It's freaking breathtaking how just profound this is. Human self-interest finds an incentive to make itself felt. And where the available quantity does not suffice for all, every individual, that's you and that's me, and that's every other person other than maybe Mother Teresa and I don't know, some other people. And what's that guy who shielded the Jews from the Nazis? Schindler, whatever. Yeah, Schindler. And there's a Catholic priest who did the same. I forgot. Every individual attempts to secure his own requirements as completely as possible to the exclusion of others. As a result, it is impossible to abolish the institution of property without removing the causes that of necessity bring it about. That is, without simultaneously increasing the available quantities of all economic goods to such an extent that requirement of all members of society can be met completely, or without reducing the needs of men far enough to make available goods sufficient to complete the satisfaction of their needs. So basically the whole issue is on private property, because what happens is, like my man Dustin was saying there before, when everyone wants something for free and there's only everything is scarce, scarcity determines all things economics. And that's what I'm watching these economists on YouTube and other sources, they always forget about the issue of scarcity. And scarcity is driven, and economics ultimately is driven by your individual decisions on what you're going to do. 1,000,000 times every day, people are making individual choices on how they're going to conduct their lives. That cannot be top down. It can only be bottom up. And in this day and age of political nonsense, of just it's insanity. If we just do this from the top down, and we should have learned this as a Republican Party, I will say real quick, under George Bush, under the freaking school, every school thing, whatever that thing was, can't have top down. It's always got to be bottom up. And the issue is the free healthcare. It can't happen. It's just not going to happen because there'll always be scarcity, always be scarcity. And when you have scarcity and you don't have a price mechanism to determine who gets fed what or who gets supplied for what, all you're going to do is chaos. And that's exactly what we're seeing in Venezuela now. So I just, it drives me crazy that we have to repeat this over and over and over and over again, that the idea of a society without scarcity is just, it's silly in of itself, has never been, has never worked, it never will. Thus, we have to make sure that every person has the individual ability to make the decisions for him or herself to best serve that person's need. Because that guy in government, he doesn't know what the hell you need. He doesn't know. Well, he would say, Josh, you don't need a cup of Walmart freaking peppermint tea. You should have, I don't care. I want Walmart peppermint tea. I like it. But Josh, I don't care. That's my decision. That's just one of many I make. So anyway, get this book. Carl Menger, Principles of Economics. I got this sucker so highlighted, so many. It's nuts, man, how much I did. This is the foundation of Austrian economics. A lot of people, I did a thing the other day on Austrian economics, and some people said, Austrian economics, they're kind of pie-ish in the sky, I guess. But what isn't pie-ish in the sky? You got to start from someplace. I mean, my goodness. All right, so let's see what we got here. I got a couple questions beforehand. Shenandoah Valley, right on. Austin, Texas. Harry, we got Stanton, Virginia. Okay, that's right. Okay, I probably asked you that before. Worcester, Mass. And then we got Plymouth, Mass, too. Worcester, yes, sir. Columbus, Ohio, in the house, right on. Dory, hey, Dory, how's it going? Please, thank you. Greetings from Myrtle Beach. Monday, my first day in retirement. UK Dano, first day in retirement, man. That's flipping awesome. Congratulations, brother. Congratulations. That's fantastic. That's fantastic. All right, so we had one question I saw first and foremost, supply and demand. You got it. At Lakeville, Matt, we got a couple of people from Massachusetts on here. All right. I saw how are junk bonds affected by cutting rates? All right, so this junk bonds are going to be a little bit different, but here's the issue when it comes what this guy was talking about, which I actually agree with. If you're willing to take duration risk is simply if you look at a mutual fund on a bond, and you all know how I don't like bonds. But anyway, if you look at a mutual fund on a bond, it'll have something called a duration. All right, a duration simply means mathematical way they quantify it. And I've never done any studies. I don't know if we can say the duration of 3 led to this happening in the future, but that's the risk we're looking at. So if a duration is 2, for the interest rate to go up by 1 full percent, all right, you have a 2 as a duration. If interest rates go up by 1 full percent, the price of the bond will drop by 2%. Does that make sense? So if you have a bond that trades at 100 and the interest rates go up by 1 full percent, the bond will now trade at 98 cents or $98, whatever it is. That's called a duration. Now, that happens. What most people worry about is the downside risk on the duration. So if you have a high duration, say 10, and the interest rates go up by 1 full percent, then theoretically the price of that bond will drop by 90. You know, there's some mathematical equations in there that I don't care to know, and frankly, you shouldn't either. And I've never understood. I don't know if someone says to prove that actually works as cleanly as stated. I imagine it probably doesn't, because like my man Andrew said, everything is supply and demand. But that's duration risk. Now, but if you counter that, what if interest rates go down? Well, in theory, it'd be the same. If interest rates go down, the duration would be the rate, your price of the bond will go up by 2% if it has a 2 duration. That makes sense. The junk bond's a little bit different because junk bonds have credit quality concerns there as well. So with a junk bond, you're saying there is some duration opportunity if they do lower the interest rates, but there's still junk bonds, all right? And maybe they're lowering the interest rates because the economy isn't as good, or maybe they're lowering the interest rate. Who knows? I don't know. But will that make these junk bonds more stable? Probably not. That'll probably make the junk bonds more likely to go kaput. So the junk bonds, you got to look at a little bit differently because there is credit rating risk involved in junk bonds more so than just interest rate risk, if that makes sense. I hope that makes sense because there's a lot going on with junk bonds. But always got to remember, too, don't forget, duration sounds good in theory, but I mean, my goodness, the federal funds rate is 2.25 right now, I think. And what's the 10-year Treasury doing? So the Fed funds rate is 2.25, and this goes back to the whole inverted yield curve thing. If the federal funds rate is 2.25, and the 10-year Treasury is right at 2, so there's a 10-year Treasury right there at 2. TNX, that's a 10-year Treasury. I mean, so if they lower the rates, all right, that's going to lower the Fed funds rate. And what does that do to the rates that are already lower than the Fed funds rate to begin with? I don't know the answer to that. It's odd to me that we're going to sit here and say they're going to lower the Fed funds rate to get it below the rate of the 10-year Treasury. We're just using that for an example. And somehow that's going to magically make the bonds go up in value. Because that's already kind of been priced in. So I don't get so this guy was saying, this anti-Trump guy, and look, I get it, man. Everyone, I mean, the guy, Mark Zandi, you ever want to take an anvil on your head, just watch this guy, Mark Zandi. He's never been right. From Moody's Analytics, it's like Paul Krugman. Now, and I will say, a lot of right-wing economists were wrong, too. Back in 2008 and 2009, we thought Obama, I'm telling you, I was there. And I'm not an economist. I just study I like to follow the economist out there, but we all thought for sure hyperinflation was imminent. I mean, my goodness, that's what all the textbooks said. Hyperinflation hasn't happened. We were wrong. That's all there is to it. We're wrong. But what was I saying? So this guy was saying you could get a double-digit return by taking on duration risk in bonds. I don't know if I get that. And part of it, by the way, my wife pointed out my shaving was a little bit lackadaisical today. So if you see a little bit of hairs where they shouldn't be, it's just because shaving my left hand is hard. But anyway, so if you have I don't know if the rates go down, will bonds inherently go up to the extent of the duration of the bond funds? I don't know. I don't see how. It just doesn't make sense to me, simply because the rates are already so far down on intermediate and longer term bonds. I don't know. So I don't know. So the question is, Robert, will junk bonds affected by cutting Fed's rates? I have no idea. And I can't imagine anyone else does too. I just don't know. Let's see here. So we got, I have a couple other questions. See if anyone else asks anything real quick before your thoughts. Hold on a second. There, okay. Taking monthly distributions from a 401k in the next 2.5 years until I'm 59.5. Should I leave the balance in index fund? You know, that's actually a good question, Tom. Someone emailed me this early, or maybe it was on my YouTube channel. I can't remember. But actually, it was an interesting thought. It was Sergio, my man Sergio, actually, who's on here. So the issue is Kitz and Wade Foul. So Michael Kitz and Wade Foul. I'm going to interview Wade. I'm hoping this week, but I'm huge fans of both these guys. I mean, when it comes to financial planning geeks, you can't beat these guys. I mean, just look at them. You'll tell they are, and like they both admit that for sure. But they've just been incredible helpful in advancing their profession beyond just a sales mentality to actually a real live educated guess, as opposed to let's just sell you a bunch of crap. But anyway, Sergio, I think he's going off. Sergio made a point. There we go. That Kitz and Foul had talked about their glide path, where they say go heavy into. Someone's lighting fireworks over there. Ooh, that scared the hell out of me. They say go heavy into bonds on the beginning of your retirement and dollar cost average into stocks. And you're kind of saying the same thing here. You're saying, look, if I go. Should leave the balance of my index fund or put all the money market into a money market fund as I take monthly distributions. Similar on the lines, thanks, Lisa. Similarities along these lines here about, look, man, I'm getting ready to retire. I'm about to retire, or I just retired. I'm taking money out of my retirement accounts in which I want to avoid the sequence of return risk. I presume that's pretty much what you're worried about there too, as well you should be. And remember, folks, sequence of return risks are if the markets tumble like that in the first couple of years of retirement, you're in a world of hurt. There's just no two gets around that. And we want to avoid that. The problem with the Kitz Foul strategy, I find, is that so the idea was you'd have about 40% or less in stocks, the rest in bonds. That way you don't get crunched on the front end of the sequence of return risk by having a majority of your assets in stocks. And the bonds will give you some reprieve for that. The problem is that we don't know that to be true. I mean, if you look at 2008, bonds got hammered too. I mean, that's just a fact. I mean, the only thing that did not get hammered in 2008 was government bonds. Everything else took it on the chin. And so the idea that corporate bonds are going to, man, fireworks going crazy. Corporate bonds are going to shield you from that potential for sequence of return risk. I don't know, man. I don't know if I buy that at all. And on top of that, without question, that's why I like the CDs. I say, screw the bonds, just go straight to CDs. So going back to your question, should you leave the balance in an index fund? I mean, the issue is we don't want you to have to draw money from an account that's down 40% like what happened in 2008. Thus, if you need money, where does that money come from to avoid having to withdraw it from that account that's down? And that's what you have to determine. Do you have the money from some other account, be it a line of credit, from a home equity line of credit? I mean, I don't like that so much. Do you have it from savings in a bank account, from CDs, from savings bonds, from life insurance? You can borrow anything other than to take the money from stocks when the market is down. But you still need to have stocks. And the reason for that is just going back to the whole, and this is where I was surprised by Wade Foul and Kitz is, I mean, the simple facts are, if you miss just 10 days, you missed everything, essentially. Up here, I got things I take to the bank. Stocks go up more than bonds. I mean, stocks go up more than down. And so the casino is stacked for you. Even on any given day, there's like a 52-48% of stocks going up relative to stocks going down or something like that. On any given year, it's like 63-37 or something like that. On any given 5 years, it's 85-15. On any given 10, it's, freaking 99-1 or something like that. Now, we don't know what the future holds, but just historical evidence said at the end of the day, we have a pretty good idea that if you're in stocks, you're more likely to have up than you are down. But we know historically, if you miss those 10 best days in stocks, you might as well just been in CDs to begin with. And you just can't afford to miss those days because if you do, you're taking all the risk, but you're not getting the returns because those few days in there is what accounts for the bulk of your returns. And it's the same kind of thing too about, in buying individual stocks. if you miss, like, I think it was like 10 stocks of the S&P 500 provide the bulk of the returns historically or something like that. Med Faber did a study on that, or did some kind of report on that, which he cited. I don't think he actually did the research on it, but it was a guy named Wes Gray, who I like a lot, actually. Wes Gray from Alpha, I think it's Alpha Analytics. I can't remember. Wes Gray, Gray. Some kind of, I can't remember, but some kind of study that said basically 10 of the 500 stocks gave you all the returns or something like that. It's the same kind of why I buy the index, why you stay in the index, because if you miss those 10 stocks, if you miss those 10 days, you're just going to have a hard time making it back. So I would say stay in the market. I just think you do. So again, my old tried and true is 3 years of cash, 5 years of cash if you need to be. I don't care. And when I say cash, I'm using cash synonymously with CDs, but 3 to 5 years that, and everything else index, and be done with it. All right. If most of the men in your family have died in the late 60s and 70s, does it make sense to take Social Security early? Man, probably. I think so, man. If you got a history of early passing, I think it would make it, except unless you have a spouse. You always got to put the spouse in there. If we have survivor benefits, remember, OASDI is old age survivor and disability income. Old age survivor is the S on the OASDI. So there are survivor benefits in there that you got to make sure that your surviving spouse can benefit from. And so, I mean, even if you're going to die at 70, let's just use me. If I died at 70 without taking a penny of Social Security, by my wife, instead of getting a $2,200, by then it'd be a $1,700 benefit because I took at 62. But instead, because I took that at the 70, it'd be a $3,800 benefit. That's, even though I don't make any money off it, that's, that she does better off for that. And don't forget, because my case, I'm 4 years older than my wife. She'll make off like a bandit, not only because I'm dead, but I'm saying that jest, but she'll make off like a bandit because she has 4 extra years to draw those survivor benefits, as opposed to, even though I lost mine. I mean, because I didn't gain anything, but I'm dead. I don't care. So I think there's a couple things that go on there always with Social Security. I think the survivor benefit stuff gets way overlooked. We got D. Casey. If we do a large Roth conversion this year, will affect our Medicare premiums next year. It's a 2-year look back. So what Medicare will do, and I don't have the paper here anymore. So let's see, today's 2019. They'll look back and see what you did in 2017. Then 2020, to look back and see what you did in 2018 and so on. So it won't be next year, but it will be in one of the years for sure. And the idea is that Medicare is going to just voluntarily grant you, once you only have that 1 year time, they're going to reduce your Medicare premiums because you're back to normal. I don't believe so for 2 seconds. So keep an eye on it in the first year of that following year when your income's low again, to make sure you're not getting screwed on the Medicare premiums hikes, because we are talking the government, man. And if anything about the government is, they want the money almost as badly as you do. So you got to keep your eye on that. Jeff, Monday. Oh, my man Jeff says something. Hold on. Okay. Congrats. Monday was my first time back to work after leaving Myrtle Beach. Yay, work. All right. So here's Matt says, with $425,000 in my retirement, what percentage do you recommend to have in bonds? Also, how many years of income to have in the savings? I mean, again, just three years. So it depends on how much you need. And what you need is also subtract out your Social Security benefit. Hey, can I make a real quick side note here? I was just reading a lady. It's actually, man, I forgot her name, but I was reading. My wife and I were going to the outlet mall today, and she drives. I was on my phone because she had sent me this article on Social Security. People made trillions of dollars of mistakes on Social Security. It was pretty tried and true argument or an article. But there's another article, and this was on Forbes about some lady, I'm drawing a blank her name, but she never came out that she's a big lib until today. And I was like, yeah, I knew it all the time because she said she spent her whole life fighting for Medicare and Social Security. I cracked up, but she made a couple good points. Now, one is that the Republicans aren't proposing anything for Social Security. That actually, I completely agree. At least the Democrats got some proposals on the board. Republicans got nothing. And I'm telling you right now, there's a huge mistake. For all of you who are leaning to the GOP, you need to tell these guys to get off their freaking tushes and own this freaking issue once and for all. I don't know why they don't do it. They're afraid of their corporate guys. There's no other way around that because the majority of their voters don't see the way the corporate Chamber of Commerce does. And the Chamber of Commerce is scared crapless of raising the cost of employment because employment is the biggest expense that people have. But what the Chamber of Commerce don't realize is that they're not going to get their way with illegal immigration, and thus employment costs are going to go up by hell or high water, one way or the other. So you might as well join on and freaking do something productive, which is to raise the cost of people's income with an increase in Social Security tax once and for all. Be done with it and put that freaking thing to bed. Anyway, that's not the diatribe. The diatribe was, which I thought was absolutely the right answer that she said here. She goes, Social Security, while it's not fully funded, is like 98% of funded for the next 25 years, like 87% of funded for the next 75 years or something like that. And the interesting thing was all these people who gripe on Social Security, but man, they are willing to get their pension from being a fireman, willing to get a pension from the government of, state of Wisconsin, whatever it was, without any concern there at all. But yet when it comes to Social Security, why is it that everyone looks at Social Security like it's the redhead stepchild as opposed to the local pensions? The local pensions that are in dire straits. Social Security is nowhere near that. Social Security relative to funding is incredibly well funded. It's not even debatable relative to some of these other pensions. Even Kentucky's pensions is the world of hurt. We know Illinois, New Jersey, Rhode Island, all these things, world of hurt. And yet people say, let's kick that count. But everyone on the road for Social Security is crazy. And I thought that was pretty interesting. Why did I start saying that? Because my man says, how much does he need in savings? Well, you got to factor out if you need $50,000 a year to live on and you're getting $25,000 from Social Security, you only need $25,000 a year to live on because 50 minus 25 is 25. But Josh, I don't believe in Social Security. He's not saying it. Matt did not say this, but I don't believe in Social Security. I just think that's crazy. I don't, especially if you have a pension from some other source. If you have a county pension versus Social Security, what do you think has better funding? It's crazy to me. And I'm not saying discount your pension either. But we got PBGC. Do you think PBGC is in a good place? It's just, I don't, it's the weird how many people are just anti-Social Security. I just don't get it. Us on the free market libertarian side have lost the debate. We lost. Social Security is here to stay. It's not going anywhere. Medicare is here to stay. It's not going anywhere. The Democrats jumped the shark with their stupid Medicare for illegal immigrants. They had Medicare for all. They could have got, which frightens me to no end. The idea of a single payer scares the heck out of me. But the Democrats had a clear road to it, except until they all stood up and they waved their hand that they want to give Medicare for illegal immigrants. So there you go. Thank you, guys. Now we're going to make it back so we can get some real semblance of free markets involved in healthcare because you just jumped the shark. Stupid. But Medicare isn't going away. Social Security isn't going away. And why the Republicans don't have some freaking free market solution. And that doesn't mean privatize like freaking George Bush said. That's not going to, no one's going to buy that. But it does mean raise a little bit of payroll tax, raise the bend point for the second bend point, raise the full retirement age. People push back. You can't raise the full retirement age. Yes, you can. You absolutely can. You have to do something here. You got to raise taxes, raise full retirement age because we simply are in an era now where the average retiree is not dying at 62 years old like he did when FDR first signed the law. The average retiree is not dying at 78 either. The average retiree is dying is mid to late 80s, as a matter of fact. So because of that, the full retirement age needs to get raised. It's just that simple. And you can raise it on the 40 years old. You can raise it on 50. I don't care, but it's going to have to go up. So that's the whole point. So back to my man Matt here. So you take the amount of money you need. You say, I need $50,000 a year, from which I'm getting 50 to 25 from Social Security. So I need $25,000 a year. You got 425. I'd probably do 4 years in CDs, 1, 2, 3, 4 year CDs. $25,000 a pop, and you're good, man. I wouldn't mess with bonds. I just don't believe in bonds. I think bonds are bad. I like CDs, and I think bonds are incredibly bad in this market where you can get better rates on CDs, so a whole heck of a lot less risk for sure. VWEX has a current yield of 5 3/4. That's the high yield junk bond. Rate cut will, I have no idea. So Mike, I got your email before. So I'm glad you asked it again here, Mike. So 57 retires 61. I plan to convert all 403Bs by age 70 to reduce the later retirement taxes. Pension and Social Security each $26,000 a year. Do I need to worry? No. What would you be worried about? That doesn't mean you don't do anything about it. So I just, from a 30,000 foot bird's eye view here, I wouldn't touch Social Security until I was 70, man. Start doing those freaking Roth conversions like a crazy man. Start them ASAP, and then 70, start taking your Social Security out. Now, the tax torpedo won't affect you unless you're taking Social Security. It won't affect you at all. So now you're 62 years old. You put $50,000 into a Roth conversion. You got your $26,000 pension. You got $50,000 Roth conversion. Your AGI will be $76,000. Subtract out whatever. If you're married, filing joint, if you're a single taxpayer, you're either going to be in the 12 or you'll be in the 22% tax bracket. Either way, it'll be a whole hell of a lot less than if you took Social Security early. So if I were you, I'd wait to take Social Security. But Josh, how do I have the income to live on? Well, that's what you're going to have to figure out. You're going to have to figure out, well, how much of that 403B do you convert on top of taking money out from distributions? And I don't know the answer to that. You have to figure it out. Or like I'm doing when I hit 62, I'm doing a reverse mortgage. There's nothing wrong with that. The fees are high. In fact, someone pointed out on a reverse mortgage on the YouTube channel today, 2 people said that he knew 2 families who took a reverse mortgage, and the mom said, "Hey kids, you're not going to inherit anything from the home because the home essentially will be accounted for because reverse mortgage will eat up the equity." It was a thought process. We don't know this to be true, but I thought it was a pretty good point. Instead, I'm going to give you inheritance today, but you're not going to get anything from when I die from selling the home because the reverse mortgage debt will equal to the value of the home potentially. And I thought it was actually pretty interesting because I've always found that giving your heirs money while they're still young and could use the money, it makes a whole hell of a lot more sense than waiting until you see that they're 65 years old. I never understood that. I can't tell you how many people have done that in estate planning. I'm going to wait until Junior is 45 and he's proven himself successful. And I was like, man, he needs the money when he was 28, dude. I mean, do you trust him? Yeah. Is he going to sniff it up his nose? No. He needs the money now. If you have the excess cash, just don't wait till he's 45 or 55. Just give it to him now, for heaven's sake. But the gift tax, there is no gift tax. Unless you're giving Junior $12 million, there is no gift tax. From my hometown, right on. Portland, Maine, says Dana. Portland, Maine, who actually knew a guy I used to run with, who knows a guy I used to run with when I lived in Peak Sound, as a matter of fact. Yep. Is that 40? Was that 48th or 4? My birthday is July 7th. I'm not sure if that's 49, Dana, or 48, but I'll be 49 years young on July 7th. Let's see. How much influence do you think Kudlow is having on the market in the background? I don't know about the market, but I bet he's having a lot of influence on our man Trumpster there, Bruce. I bet he is. And I'm a big fan of Larry Kudlow. Always have been. Remember, wasn't it used to be Kudlow and Kramer back in the day? I don't remember. But I remember Kudlow has always been one of my favorite economists for sure. And I think he used to write the National Review back in the early 90s before there's even cable news and all that. But, yeah, I don't know. I'm not sure how much he's having on the market. I don't know. Are HSAs worth contributing to? And once all of the retirement streams are maxed out, yes, HRSAs are fantastic. Rich says he doesn't see the rates going down at all. We're talking short-term rates, and the Feds they're gonna probably cut potentially the short-term rates. So that'd be your CDs. Again, another reason to go ahead and lock in CDs right now. I don't think on the longer term those be much of an impact. I just don't. I think it's already priced in there, which is why the Feds would probably lower them. Because right now they're showing they're somewhat inept. Not inept like they don't know what the hell they're doing, but more like whatever they're moving. They're not in control as much as they want to seem. I mean, because you look at the 10-year Treasury, the 10-year Treasury is below the federal funds rate right now. What does that show you? It shows that the Fed is completely disconnected with the economy as a whole. And so because they don't want that, they don't want to relieve themselves of their authority. They need to get that authority back. And the way they do that is to get more in line with what the real world is calling for. And so you can easily see them cut the Fed funds rate. I'd be stunned if it had anything to do with the 10-year Treasury, because the 10-year Treasury is already below the Fed funds rate. YouTube channel advice, Jerry. Right, Jerry. I just remember anytime you're doing a YouTube channel, my friends, make sure you title it something of interest. Sometimes I don't. Sometimes I have, Josh Q&A or something like that. But especially on the front end, the biggest success I had was the biggest video that started, probably a lot of y'all came here, was my taxes and retirement planning video. I did on my probably 12th video or something like that, where I said you don't need $950,000 to retire. And the title was Taxes and Retirement. I can't remember what it was, but anyway, it had retirement planning in the title, and retirement planning, if memory serves, was in the first sentence of the description. So I talked to a guy a few months back, and he's like, "Man, I can't believe how many subscribers you have. I've been on here for 5 years, so I only got 400." And I looked at his YouTube channel. It's all vlog out with Johnny, or vlog out with Brenda, or whatever the hell it was. I said, no one knows what that means and no one cares. I mean, you got to title it something different. And what it turned out, he was doing all this, I think it was bass fishing. It's pretty interesting, actually, if you're into that, which I am not. But I said, man, and I showed him some other examples of other YouTube channels on that same niche, killing it. And I said, you see the difference here, because there weren't any better production. They weren't any nicer people. Nothing. It's just they titled it better. So it drew the attention of obviously people who are interested in that, but also the YouTube algorithm. I said, you got to title things. You got to title it correctly. No one cares about Jerry Welch's vlog. They do care about Jerry Welch's best restaurant advice in Maine or something like that, or whatever it is. That's what people like, Like I was just looking up the other day. What was I looking up? I can't remember. I was looking up something. Just today was the best time to harvest potatoes. And I said, best time to harvest potatoes. All right. And if Jerry had said the best time to harvest potatoes, if he just put in there Jerry's vlog 15, that would not have shown up. So the best time to harvest potatoes, that would be when I did my potatoes. I'd put a picture of them. I got a friggin' ton of potatoes off. I just did 5. I did 5 tubers in there. I got a friggin' ton of them from that, 90 days ago. So best time to harvest potatoes should be in the title. And the description should say in the first sentence, best time to harvest the potatoes is XYZ. That's number one. Don't get too caught up in look, dude, it's just me on this Chromebook. Half the time it's me on this phone. And as you can tell, there's nothing fancy. I don't have any green screen or anything like that. Like that guy, Graham Steppen, has all this stuff, which is great. I'm not going to take the time to do all that. But you don't have to get too technical. Just make sure the volume is good. In the middle, before I got this MacBook, I was having an issue with the volume, the audio, and that really sucked. I was really worried. I was like, oh boy, but I was able to get this MacBook to fix it. I always like gold, Robert. I think everyone should own gold. Absolutely. Not just a mining stock. Don't care about that, but the actual gold, without question. Everyone should have gold bullion, without question, in my opinion. Some videos on the economics of Milton Friedman. Yeah, I'll show you something right here if I can find it. Ooh. I'll show you something right here. Oh no! Oh, it's an older one. I got a book signed by Milton Friedman. It's not this one actually. It's my other free to choose, which I don't know where it is. But I got a signed book by Milton and Rose Friedman. Isn't that crazy? And I also got one signed by Thomas Sowell. Look at that. He signed it to me. So I wrote him a letter. I said, "Dear Dr. Sowell, why are the race hustlers still trying to create chaos? It just, as a white guy, ticks me off, all these guys out there who are trying so hard to bring the races apart as opposed to put them together." And he just sent me this book. He says, just got to hang in there. and fight the good fight. And I tell you, that was freaking. I love this guy, Thomas Sowell, man. So here's what the old school economists, who before they got into econometrics and economics department, got all science envy, where they want to be like physicists. This is the way economics should be. It's just basically, it's like philosophy, it's math to some degree, but it's not econometrics, it's not PhD and all that crap stuff in terms of statistics. There's some probabilities, I get you. There's some analysis, whatnot, but it's more philosophy. How do human beings do things? It's interesting. Richard Thaler, who got the Nobel Prize for behavioral economics. Why do human beings engage in irrational activity? It doesn't make sense from an economist perspective, because rationality, the utility of doing X over Y, but that's the whole point. Human nature isn't that rational. It's irrational. And Thomas Sowell is one of the last of the people who come up through the economics department, not focused on math. Now everybody is so heavy on math and economics, it just is killing themselves without question, because they can't relate to anybody. So you read these guys or watch these guys on CNN or whatever that was, CNBC. No one knows what the hell to talk about. And the funny thing is, they don't know what the hell to talk about. And even the funnier thing is, they know it. They don't know. They're sitting there thinking, well, our graphs show this and our stuff. And it's all. Yeah. I plan on putting all of my money in one fund, Vanguard Wellington, when I retire from my stock investment, and pull out 4% a year, not taking any inflation raises. Why only 4%? If not taking it adjusted for inflation, why not take 5%, Kenny? I don't get that. There's actually no reason only to take 4% if you're not adjusting for inflation. Cash is king in early retirement. I think cash is king, Harry, all the time. Absolutely. Is it better to reinvest dividends or move to money market? I always like reinvesting dividends. Absolutely. Buffering. I'm a huge fan of reinvesting dividends, and I did a. I think I threw it away. If you get a chance, folks, go to Google American Funds ICA Guide. That's the Investment Company of America, the ICA Guide. American Funds ICA Guide is probably the best literature for investments you'll ever read. So easy to read. It's flipping awesome. So what American funds do is they'll show, going back to the Investment Company of America from I think it was founded in 1934. They show the difference between dividends reinvested and dividends not reinvested. And it's insane. It's in freaking insane. Not reinvesting your dividends that's bad. So reinvest them. Yeah, and Mike says, I don't think I'd ever buy a bond I wasn't prepared to hold to maturity. I think if you're going to buy a bond, hold that sucker and buy it individually. Absolutely. Looks like I'm, let's see here. Hold on just a second. Oops. Looks like I'm 2 months behind you. Okay, take it. Okay, was about to retire. State pension, basically deferred savings, 403B and IRA, and we'll have Social Security. If I move to another state, I'm assuming my current state will still tax on pension. If you move to another state, will your current state that you're currently in still tax on pension? I don't think so. A lot of states don't. In fact, I did my whole video series on state-by-state taxation for retirees. A lot of the states are pretty favorable. They won't tax your pension I remember like California. If you left California, they're not going to tax your pension because you're no longer domiciled there. Which goes back into my whole thing from last week where I read you the Supreme Court decision that North Carolina was trying to tax the income of this trust that this resident of North Carolina was the beneficiary of, which he never received. The trust wasn't in North Carolina. The trust never paid the income to her. She had no ownership stake in it until the trustee, which was not her, gave up the money. The trustee did not give up the money. And yet North Carolina was still trying to tax her for income she had never seen. It was freaking insane. The idea that went to the Supreme Court was just nuts as it is. But as we see here today, a lot of those states are pretty favorable. If you don't live there, they can't tax you. It's all there is to it. That's why I tell everybody in New York, be careful. New Yorkers seem to find a way around the rules. They can get anyone they want. But I can take them to court. Yeah, okay, good luck with that. Would like to move, yeah. My 403B as investor and institutional shares. Institutional shares are typically a little bit cheaper carry than investor shares, usually by 10 basis points, which is 0.1%. So I would definitely do the institutional shares for sure. Someone asked last week if you need to make estimated IRS tax payments to IRS if you convert 401k to Roth. Answer is maybe. Right? They want 90% of your tax burden paid. That's funny. Good, right on, Vic. That's fantastic. So the question was, if I make a large or any kind of Roth conversion, do I have to pay estimated tax? And I don't know the answer to that. I've seen both sides of that. But Vic says the IRS wants 90% of your tax burden paid, essentially. So if you have, taxes on $10,000 on a Roth conversion that you did in June, they'd want 9,000 of that to be shown up in the Treasury by June. Actually, my wife works for a CPA firm. They have this thing called Safe Harbor. And she asked me, she goes, do you know what Safe Harbor is? I said, Safe Harbor 401ks? And she goes, no, Safe Harbor tax stuff. And I said, I don't know what it is. And basically what it is they send 110% of the estimated taxes for a safe harbor to make sure the IRS is happy. So that's it was interesting. So I asked my wife something else about taxes from this thing from we did last week, and I forgot what she said. I have to think about that. I think I might have asked about estimated taxes. I can't remember. Sucks to miss the upside. If your 65th birthday is early in the year, can you still count on a 2-year look back, or could it be 3 years? I've never heard 3 years. Mike has always been 2 years from what I can tell. In fact, I think the IRS's web or CMS, Center for Medicare and Medicaid Services, says it specifically. And again, I don't have the form. Maybe I do. I think I might have thrown it away. But it says 2 years on there. So I think you're safe for 2 years, but yeah, I think I threw it away. Estimated taxes. Yeah. So this guy says, Tom, just be safe and do estimated tax and make sure that you make them even every quarter, depending on when you do it. You'll be hearing from AARP soon. Does it make sense to pay for Roth conversion with funds inside the IRA? Okay. So Isaac, my man, I had a guy who's a pretty technically astute dude who did a spreadsheet for me when I did a video on this a long time ago. He was doing Roth conversions and paying the tax from the 401k, and even then he still came out ahead. The rule of thumb is that you want outside money in which to pay the Roth conversion, and the reason for that is simple. $100,000 from a traditional IRA or a 401k to a Roth, we want $100,000 being in there to go tax-free. $100,000 from a 401k, of which we'll just say 10,000 is taxed. Well, now you only have 90,000 growing tax-free, and that's the idea. At the end of the day, though, the way the tax situation is for a taxable account, if you do this right, a lot of people won't. If you have low dividend, low turnover stocks or mutual funds, or better yet, ETFs, there really shouldn't be a whole lot of taxation in your investments that are outside your IRA anyway. In fact, I was getting into it was a somewhat fierce argument with a friend of mine the other day. He was really upset by a video I did when I was taking on the investment industry, and it was bad. I felt bad for the guy because he's really, really upset. And I said, dude, I don't get it, man. He was trying to justify the fees they charge. And there's a firm that many of you all would be familiar with. And I was like, look, you charge what the hell you want. I don't care. But the facts are you're not making it, you don't disclose it on the front page of your website. You don't disclose it anywhere for anyone to see. And it's on the ADV form that people got to hunt for. And then he just told me right there that the fees are negotiable. I said, what the hell is that? So, I mean, I don't like that. I mean, they can do whatever they want to do, but that's not transparent. I don't know how you hold yourself as fiduciary if you don't disclose your fees on the front end. And to say, well, this is what we state for the SEC, but we're willing to negotiate. I don't like that. Anyway, the whole point was he's saying we charge whatever it was. We'll just say 1%. And I said, so basically, and he's saying, and people, that's a fee that's worth it. And he gave me an example, which is so elementary. I was stunned by this. He said, if you have a guy with $500,000 in a taxable account, $500,000 in a Roth, and $1 million in a traditional IRA, and he's a 50-50 investor, how should he be invested? I was like, dude, I thought he was joking because this is such a simple question to answer. I said, you're joking, right? He goes, no, I'm not joking. I'm serious. And I was like, you do all the bonds in the IRA and you do the aggressive stuff in the other two accounts. Literally, it's the most simplest thing ever there has ever been for anyone who follows this. And the reason for that is because everything that comes out of the IRA is ordinary income. All right. Everything that comes out of the Roth is tax free. And if you invest it correctly outside of the IRA, outside of the Roth in a taxable account, that can be tax-free as well, because qualified dividends, if there's minimal, they could be subject to zero tax depending on your tax bracket. Long-term capital gains, if they're minimal, they could be subject to zero tax because of your tax bracket. ETFs are very tax favorable. All right, so ETFs, the turnover there is going to be minimal at best. And the way the taxes are built around ETFs, it gives them a lot more wiggle room that they don't issue taxable events the same way a mutual fund does. So essentially, there is no taxable distributions from an ETF, and there's no way you should buy a dividend ETF in a taxable account, because why pay tax? It doesn't make sense. So anyway, at the end of the day, what would happen is, going back to this long-winded answer to your question, my man Isaac, it essentially doesn't matter. I mean, it's a little bit better to take it from outside money rather than the traditional IRA money. But if you do tax planning correct, it doesn't matter. But Josh, when I die, remember, taxable accounts transfer with a step-up basis to your heirs, which means there is no tax on the gain. There is none. So $500,000, if it grows to $750,000, and you die, Isaac, and you leave it to your better half, it doesn't matter who it is. You can leave it to me. You leave it to your old buddy Josh. I inherit that $750,000 account with a tax basis of $750,000. So if I were to sell that sucker the very next day for $750,000, I pay no capital gain tax at all. You paid $500,000, that $250,000 stepped up into the $750,000 date of death valuations, which means I inherit that sucker and I owe no taxation whatsoever on anything at $750,000 or below. Nothing, even though there is $250,000 of unrealized gains. That's a step-up basis. So Roth works like that. The taxable account works like that as well. The taxable account, the benefit is there is no mandatory distributions for non-spouse beneficiaries, where in a Roth there is. Now, this will go back to the second point. The drawback about a Roth is I can easily see they're going to put limits on non-spouse beneficiaries, being able to stretch those accounts over. Right? That's I can see that happen a mile away. That's nowhere near. No one's proposing that at this stage, but trust me, in a future tax circumstance, there'll be a limit to how long a non-spouse beneficiary can stretch out the distributions of an IRA that they inherit. But that's neither here nor there today. Should I invest all my money or percent of my 15? I have no clue, man. 62, should I invest what you have in your 15,000 HSA? There's no way I can answer that. I don't know. The online money market just cut their yields this past week. Isn't that interesting? Because they're waiting for the federal fund rate to go down. That's interesting. I'm going to join Bruce. Thanks, guys. Lauren got an email from Ally Bag. Is that what Graham Stephen was talking about? Stephen, whatever his name was. I saw he did a video that says why I'm leaving Ally. Was that because I didn't watch the video? I watched Graham's videos. That one didn't have any interest for me at all. If you do the conversion in the fourth quarter, then just one payment on January 15th, no penalty. All right. Okay, well, that's good. So Tom says if you do the conversion in the fourth quarter, then you just need to make one estimated payment in January. If you do it in the third quarter, you need to make it two payments. That's interesting for estimated payments on Roth conversions. Wealthfront has a savings account currently paying 2.57. Wow. That's pretty high. I think, let's see here. What do I think of dividend ETFs versus stocks? I just like ETFs. I don't like individual stocks, Robert. Right. Hey, my man Dennis. What's going on, Dennis? Love your show. If you move your money from a 401k to a Roth in your gap years prior, starting at 64, can you not touch that term until? Okay. All right, yeah. So Dennis asked if you do a Roth conversion, and you're over the age of 59, can you not touch the entire amount until 5 years after the last conversion? The answer is no. You can always touch your principal. I mean, just think about it. After the age of 59, you can always touch your principal. You can't touch your earnings tax-free. And if you think about it like this, if you're over the age of 59 and took a distribution from a traditional IRA, could you do that without penalty? Yes, absolutely. So if you're over the age of 59, could you take a distribution from a Roth without penalty? Absolutely. The question is, can you take a distribution from your gains? It won't be without penalty. Well, it will be without penalty, but it won't be without tax. You have to pay tax on that. So, Dennis, to answer your question, yeah, you have unencumbered access to your principal. You do not have unencumbered access to the gains until 5 years has transpired. What do you think about withdrawing money from my 401k to pay high interest credit card debt? Instead of withdrawing money, well, if you, yes, yeah, absolutely. But instead of withdrawing it, can you borrow against it? I borrow against it, Chris. You're still working as an employer, which is another reason I'm telling you right now. All these people roll your 401k to an IRA. I said, whoa. Hold on there. They're smarty pants. You can always move 401k to 401k, most likely. And the very few plans don't allow that. So if I'm Chris and I got a 20% credit card debt, we'll just say it's $20,000. I got $100,000 in a 401k and I'm just getting ready to switch companies. And I want to pull that $100,000 out with which to pay off that 20% credit card debt. Nah, screw that. Just move that 401k to your new employer and take a loan against it. Absolutely nothing wrong with that. Pay that sucker off. Absolutely. George says, right about CNBC. It's all for entertainment. Yep. I agree. I pay a little bit. Okay, let's see. All right, sweet. ICA guide. Yeah, I'm telling you, man. Thanks. Reinvested regular dividends can contribute significantly to a fund's return. Yeah, in fact, they accounted for over 34% of the ICA's total return over the lifetime. What you'll find, I think they did like $100,000 or something like that, or $10,000 in 1934, and it grew to like $110 million at the end of 2018 with dividends reinvested. But if you didn't reinvest the dividends, it only grew to like 12 million bucks. It was freaking insane. It was insane. And they give you this chart as a visual for you to see. It's incredible. So can I purchase a software you use to estimate different? Yeah, it's software on my website, $150. Yes, sir. So D Casey, just send me an email with your, and I'll set you up. I'll send you a PayPal thing, and then once I get that, I'll set you up, and you're ready to rock and roll. Any adjustments need to protect from recession? You have talked about 2-bucket approach. Any adjustments, my man Bruce says, need to protect from recession? No, and that's the problem, man, because even during recessions, I mean, if you look at historically of the markets, the stock market particularly, the best 10 days account for the bulk of them returns. I mean, so, and those can occur during recessions too. In fact, was it in my charts someplace around here? I can't remember, but anyway, my charts someplace around here in my stack of stuff, so to speak. I got a visual from some firm, and they show you exactly the best 10 days of which, how many of those happened in recessions? Like three of the best 10 days over 20 years. So yeah, nothing, Bruce, just got hang tight and know the way around that. And again, look, this guy that my man Rob sent me on this anti-Trumper economist who's on CNBC, or I think it's Bloomberg. He thinks we're in a recession right now. And I'm thinking, okay, so if this is a recession, what's the big flipping deal? You see what I'm saying? It's like, because remember, for the National Bureau of Economic, NBER, Economic Research, before they actually declare recession, it had to been 2 straight quarters of negative GDP growth. And how are they going to know when the recession happened? Well, it's hindsight. They're going to look back and say, hey, last year we were in a recession. You're like, okay, but now we're 6 months beyond that. Well, thanks, guys. So this guy's argument is we're in a recession now. The NBER doesn't know that yet because they're always looking hindsight. So if we are in a recession today, okay, we're all still here. The bombs haven't dropped, and Trump's out there talking to a Kim Jong-un, first president to go to North Korea, I think, since the war, which I find to be incredible. I absolutely do. It's great. Anyway, on top of that, so no, Bruce, just keep some money on the side for sure. Do you like the idea of taking 40% of one's 401k and buying a 10-year period certain annuity at 60? Whew, that's a good question, Harry. Yeah. I guess the question would be, the strategy in of itself is fantastic. So Harry's saying, I'm 60 years old. I want to defer taking Social Security till I'm 70 because I get the 8% delayed earnings credits plus the cost of living adjustment, and Social Security is taxed much more favorably. But I need some money between now and I'm 70. So what if I took 40% of my 401k and annuitized it into a 10-year period certain annuity to cover the lack of Social Security income I have between now and then? What do I think about that? And that's what a 10-year period certain annuity is. That means after 10 years, that sucker stops. All right. So a 10-year period certain, after 10 years, it stops. It will pay for 10 years and not one day more. So Harry could die tomorrow because of all the hot air I'm feeding him on this YouTube channel. And he's just, or he could live for 20,000 years. It doesn't matter. It will pay somebody for over 10 years, be it Harry's beautiful side, or Harry's kids, or old buddy Josh. It could be anybody. For 10 years, someone's going to get the money, and after 10 years, it's done, regardless. The only question, it's a freaking awesome strategy, Harry, without question. The only question I consider is, what's the difference between a survival or a life income annuity as opposed to a 10-year period certain? If they're anywhere within spitting distance, I would take the annuity for life. I bet they're probably not, but I don't know. I haven't run annuity quotes for a long time, but that'd be interesting. I'm a huge fan of that scenario. In fact, I need to do a video on that. Let me write that down. Harry, you got my email? Can you email me that? I want to run some scenarios on. I haven't done a video on annuities with Social Security. I don't think if I've ever done one, it's been a long flipping time. So if you're still here, Harry, if you could send me an email, I would love to run some quotes on that. I think it's a fantastic idea. I'm trying to think the drawback. The drawback, of course, is what if the markets don't return historical norms? And I don't mean historical like 12, 10% Dave Ramsey stuff. I'm just saying above and beyond the rates of bonds. What if we get 2% return? I don't know. Well, I guess it wouldn't matter because you're still in the market anyway now. So you're, I think it's fantastic. I love it. I hope you all fall on that. I think it's, hey, we just broke 160. We never had this many people on here. So for all you, I just want to say thanks real quick. I do. It's humbling, the idea that your old buddy Josh, a year and a half ago, a year and 3 months ago, started doing this YouTube channel. And I just become friends with a lot of you guys. I freaking find it awesome. As much as YouTube and Google and all these freaking left-wing Nazis out there are crazy. I was watching this guy again today. Some black lady out of Louisiana showing me how to make cube steaks. I said, this lady and I would never know each other. She's in some place in Louisiana, and I don't like Louisiana. Love you all. Louisiana, got good friends there, but man, Louisiana does not do anything for me at all. And here she is on YouTube running some awesome, her name was Just T. Huge fan of Just T. This is if you're looking for YouTube entertainers, this guy named Flossie Carter. Oh my gosh, that guy's Flossie Carter. That guy is. Hey, yo, YouTube's your boy Flossie here, and I show my kids some of his videos where he's doing these things where he's got phone things. He starts throwing them over. Oh. It's awesome. So as much as I hate YouTube, I don't hate YouTube. As much as it drives you crazy, them freaking banning whatever that guy's name is, Alex Jones. At the end of the day, it's wonderful. The fact that you guys are here. Some dude just gave me $5, man. What are you doing? I love it. It's just the idea that your old buddy Josh sit here just yapping away. It's insane. I love it. Thanks for who gave me that. So we got to see if that guy or person, my man, Rob, Rob's such a good guy. All right. Before I want to get to something right here. I was going to do a video on it, but now I'm yapping. I just looked over my shoulder. Here it is. This is from First Citizens Bank, first quarter 2000. And this is actually a newsletter from DLJ. Now, you all probably, some of you might know what DLJ is. Donaldson, Lufkin, and I forgot the J stands for Genret Securities. So DLJ was big back. I have no clue if they're still around. But I want to share something with you. So remember, so basically what happens, First Citizens Bank, they paid for their subscription to DLJ's newsletter. And I just want to show you something. So this is 315. I don't know if y'all can see that or not. So look at the S&P 500. It was at, what's that, 1405. All right, there's the NASDAQ at, where's the NASDAQ? I can't see it. At, so NASDAQ already got killed. All right, so NASDAQ already got killed from the 5,000. Look at the 30-year Treasury, the 3-month Treasury bill, 5.85, the 3-month Treasury bill. Anyway, I want to share something with you. So all these prognosticators. So I'm going to read you the first quarter 2000. Let's see. A return to the psychologically important 10,000 point level for the Dow Industrials has cast widespread doubts about blue chip stocks, which have long been the mainstay of the U.S. economy. The doubt, because of the Dow went above 10,000, then came below a little bit 10,000, whereas at about 10,100. So they're saying, oh my goodness, the Dow goes below 10,000. That could cause doubts among the long about the market. The Dow's decline reflects the selling of traditional industrial or old economy stocks in order to jump into the currently perceived faster growing technology-related stocks of the new economy. Investors have decided to pour money into revitalized sectors such as bioconductors and semiconductors, biotechnologies, plus a number of emerging areas such as business-to-business, internet, and fiber optics. Now, overall, we remain bullish towards equities, but caution that the months ahead could well be volatile as the Fed's monetary policy unfolds. The central bank's FOMC, the Federal Open Market Committee, noted at the conclusion of his last meeting the potential for heightened inflationary pressures still exist. These comments, plus recent economic data, have heightened expectations for an additional rate hike in March of the next OMC. Going forward, our price target for the Dow at the end of 2000 remains 12,995. Assuming a peak multiple of 23, our 2001 price target for the Dow is 13,455. 13,455 is what the price target was. Now I'm going to read you something from, where is this from? This is from Business Week. I don't even know if Business Week is still published anymore. All right, so this is Dateline. What date was this? I can't remember what date it was. September 25th, 2000 issue. September 25th, 2000 issue. Going up. You know what Business Week projected was going up? In the past year, Enron stock has more than doubled to 73, with shares trading at a lofty 44 times earnings. Enron has had a great run, said Oscar Castro, manager of the Montgomery Global Communications Fund, but it's still a good long-term investment. Another fan, Chris Wolf, who's a strategist at JP Morgan, expects Enron share price to hit 100 during the next 6 months as the company sees rising trading profits from volatile energy markets and a rapid expansion of online trading. The point about that is just, and all these prognosticators don't know what the hell they're talking about. No one has any idea. The interesting thing is we always can laugh at the people who called for increases in the I think it's Irving Fisher, right? The economist from the late 20s and early 30s, who was just wonderful economist. But he said basically the market had reached a floor that was right before the Great Depression. And he's always been kind of like, you fool. And I think he went bankrupt because of it, as a matter of fact. It's always easy to say all the people who called the ups. I want to freaking start throwing mud at the people who always call the downs, the Mark Zandys of the world, all the naysayers. I want to start throwing mud at them. So I got this right here. And I say, hey, these guys called the Dow to be 13,000 freaking 500 at the end of 2001, and we know what happened. And we got this guy saying Enron's going up at the end of 2000. We know what happened there. And it's always easy to throw mud at these guys, because they're all ass clowns. But how about the ass clowns, the Mark Zandys of the world, all the Paul Krugmans of the world, all the economists? I don't care what your political stripe is. I frankly don't care. How come they all get a free ride? I don't get it. How come the naysayers? No one ever holds the naysayers. When are we going to start holding the naysayers accountable? How come it's always the optimistic people? It drives me crazy. So no one wants to be optimistic, because if you be optimistic and you're wrong, everyone throws arrows at you. But if you're a naysayer, doomsday purveyor, and you're wrong, people say, maybe try it again next time, Harry Dent. Try it again next time, freaking Krugman. What's that guy's name? Thomas Friedman, singing the praises of China. It would never. Crazy. Let's see. All right. Can I purchase? Yep. Told you about that. Please share where you found out about timing of. Okay. CD rates have gone down a little bit. Yeah. Okay. Vic, 1 year down to under 2 now. Okay. You got to lock them suckers in. They're probably going down more. What to do with the 100K so I can make it grow the next 10 years without having to pay taxes every year? ETF. Absolutely. Without having to pay that. Yeah. Banking. Okay. Jeff, I'd put that sucker in a small cap growth oriented ETF. No one I know Jeff. So if you don't look, man, this is for Jeff specifically, not for anyone else, because I don't know you, but I do know Jeff. I'd put that sucker in a small cap growth oriented ETF with no dividends. And well, that's it. So small cap growth oriented ETF, and let it just ride without question. Yeah, right on, Chris. Take out a loan, not draw my 401k. 100% on board with you, brother. In fact, a shameless plug for my book, where I talked about how you can increase your net worth by borrowing from your 401k to pay off high credit card debt. I prove it there. Someone actually made a point on my YouTube channel where I said there's no double taxation of 401ks. He actually pointed out there is double taxation on the interest that you make for paying yourself back. That's actually true. So you're going to make a little bit of interest on you're paying the money back post-tax, and you're paying it back. The growth will get you some interest, which you got to pull out after tax. So it is double taxation on the interest that you're getting. All right. So that was true. Whoever said you might not be on here, it's fine. I'm willing to admit when I misspoke, but you're not paying double taxation on the vast majority of the borrowing from your 401k. It's just not happening. You are paying a little bit back on interest, presuming that you have any, by the way. But that's going to be small potatoes. We're talking, a couple $100 of taxes relative to pay off your freaking crappy your credit card debt at 20%. It's not a deal breaker in the least. But he was right. It's not as cut and dry as what I said. So I'm willing to admit my mistakes. I'm going to hang up my financial planning. He was actually cool. He wasn't a dick, so I'm just joking, though. Hey, man, take it easy. You don't go crazy. Norcos. I don't even know what a Norco is, man. North Koreans? When is it not appropriate to make a Roth conversion from an IRA? Paul, believe it or not, I get this more than I like to acknowledge when I'm running financial plans for people. Single people in particular, it's tough to make a huge justification who are working. Single people who are working or who have high income for whatever reason, it's tough to say you should pull the taxes forward in order to avoid lower taxes in the future. I don't see any benefit of that at all. But it's not just that. It's a lot of times people with pensions. If you have a pension and you're in retirement, or if you're making good money, and that retirement, the best time to do it is when you're making good money and it drops off a brick because you're 60 years, or like a brick and mortar because you're 60 years old and you don't really have any income until Social Security kicks in. If I was talking to a guy the other day, he had a pretty significant pension, and I can't remember if he was married or not. I just can't remember, but he had a pretty good pension. I was like, I just don't see the benefit of it, man, because you're going to be pulling all this money forward to pay tax on. And I think he might have been single. I just don't recall. But anyway, at the end of this, like, we're putting a lot of hope in the future of increased taxes, because if that doesn't happen, you're pulling all this money forward and you're going to get killed from the front end. And it's just not going to be as cut and dry on the back end. It's going to be beneficial to you. So it's really a lot of folks with pensions. It's a wonderful thing to have. Having a pension is great. I'm telling you right now. But if you have a pension, it's tough to do real heavy tax planning for Roth conversions, especially if you're single. If you're single with a pension, I don't see any benefit hardly at all. And this other guy was asking, should you do Roth 401ks as opposed to traditional 401ks? The same concept. He's got a pension when he retires, and the answer is no, because you're never going to be in that low of a tax bracket really ever, in which you're going to be able to do much tax planning. It's just not going to happen. And so that's it, really. I mean, if you're have pensions, have high income, it's tough and you're single, those three things right there make it tough. I always go in with it that you should always default to do Roth conversions, but try to prove yourself otherwise. So that makes sense. And a lot of people do it the other way. They say they should always default to do deferrals and try to do Roth conversions and see if they can talk themselves into doing Roth conversions. I think it should be the other way around. The default should be Roth conversions. Run the numbers until you can prove otherwise that it's not worth it. Estimate, let's see, not there even close. So 57, should I use an inherited? Okay, yeah, right on. Mike, this is your other question. Should I use an inherited IRA to help max fund my 403B in 457? No 10% early withdrawal, not on inherited IRA. Mike, I don't know, man. So the question is, should you take the inherited IRA, pull the money out for which you have to pay tax, and put it back into the 403B and 457 to take the tax deferral? Yeah, that's a little bit too cute by half, in my opinion. Everyone's against taxable accounts. I'm not. I like taxable accounts. I mean, if you did not have for the vast majority of people, if you did not have a match on your 401k, I just don't think 401k is that much worth it. I just don't, especially when you can put it into a taxable account and maintain it so it's not paying a whole lot of taxes. I don't know why everyone's against taxable accounts. We've been ingrained into our head to do these tax deferrals, and I frankly don't. There's not that much benefit for some people. I mean, my goodness, high income people, single people, sure. The vast majority of us, the tax deferral is not that great. I did the study on Larry Kotlikov's paper about from 2001, how contributing to your 401k actually raises your taxes in the long run because of tax torpedo. I just really think we need to get beyond looking at the tax deferral as if it's God's chosen investment plan, because it's just not. Yeah, right on, Mike. Harry scenario. And there's my man Rob. So if you're interested in sending money to me, and you should be, because I'll put to good use. What will I buy? I'll buy some. I'm making some beef jerky right now. Got some beef jerky cooking down there. So we got some. What did I do? Half cut sirloin, quarter cut sirloin. I can't remember. Anyway, thanks, Rob. So to send money to me, your old buddy Josh on this thing is called the not live chat, super chat. So if you are interested and you want to do the super chat, by all means do so. Jack asked me how the course material is coming along. Crappy because of Splinty. My best friend here is Splinty. So until I get Splinty going up, Jack, it's not happening. Someone actually sent me a deposit for it, and I had to send it back to him. I said, no, not ready for that yet. It's probably about a month behind now. Sorry. Because I have to be able to write. I want to be able to write on the whiteboard. I just can't do it. And my left is horrible. No, the narcs. Yeah, thanks, man. I'm not taking the freaking perks anymore. I was taking perks a little bit. I'm not taking those anymore. I do get worried about addiction. Look, we're Irish. It runs deep in our family, alcohol addiction, all kinds of different addictions, trust me, deep in our family. And I do get nervous about that. So I took the perks. I was very nervous about it. It did the job it's supposed to do, and now I don't take them anymore. Appreciate it. NYL is paying 7.2% at 72%. I bet that's a distribution yield at 75 years old. That's pretty good, man. That is, if I'm looking at an income annuity with New York Life, I can get 7.2% payout at 75 years old. That seems pretty good to me. Once you can get over that 7% threshold, that's pretty good. If that's what my man's saying here, I have a feeling it is. Remember, the distribution yield, some guy made a kind of snarky comment on the YouTube the other day about, oh, where can I get 5% annuity at 5%? That's great. I was like, dude, it's not a freaking guaranteed income. It's the distribution yield. Stop. So 7.2% is not the yield you're getting as if it's a stock yield or a CD yield or a bond yield. It's a distribution yield. So a portion is return of capital or a portion is income stream. So you always got to remember that. For like charitable gift, this used to confuse me to no end. Charitable gift annuities. I don't get magazines for all day anymore. I get Popular Mechanics and I get American Rifleman and I get Backwoods Home. That's the only I think that's it, right? Those three. And I don't know if they have but some of the magazines I used to get, they'd have charitable gift annuities with a yield of 6.8. I was like, man, how are they doing that? And it never said it was distribution yield. It always just made it seem like that was a yield you're getting above and beyond your principal. And I always wondered that for the longest time until 10, 15 years ago, I was able to figure it out. So that's not the yield, that's distribution yield, return of principal plus income. And they never said that, which kind of ticks me off. I've been pondering the annuity thing to cover 67. Yeah, Beth, right on. Definitely interested. Okay. No, there you go. That'll be mission number 1 for mañana. That means tomorrow in Spanish, my friends. But if you watch the Democratic debate, you would know that, right? Oh man. Eisman 57, 62 and a half single, no dependents, 425 for traditional, 175 in Roth, liquidating a modest second home, which should free up 100K, keep proceeds of cash. I'd probably or do Roth conversion. Yeah, I'd do Roth, man. Well, I don't know. Single, I'd do Roth. I'd wait till take Social Security at 70. Eisman 57. Do Roth conversions now. Get everything over from your traditional to the Roth by the time you're 70. This is a good one too. Do me a favor, if you would, my friend. If you get a chance, email me as well. I'll do a video on this because this will be an example of a single guy. All these single people yell. No, I'm being silly now, but they're all like, you should do more stuff on single. I said, I do tons of stuff on single. This would be a good one right here. So the issue is 175 in Roth, 425 for traditional. He's got 100,000 sitting in cash. So do you do proceeds and cash reserves or do Roth conversions? And I'll add. It all depends on Social Security. But let's just say we're able to get that 425 over to Roth IRAs between now and 70 years old. So we have 425, divide that by 7. So it'll be 60,000 a year roughly he'll convert to a Roth. By the time he's 70, how much taxes will he owe if everything is Social Security and Roth? Nothing. No taxes for the rest of his life. Oh, it's nuts. By the way, someone had just written on here about the RothIRA.com. I'm starting a brand spanking new website with my man Dave Simon, who does all my website stuff, who also had a rotator cuff surgery not too long ago. He's out of Pennsylvania. And Dave was a bodybuilder before not that long ago. And he told me when he had physical therapy, he said he was in tears. It hurt so bad. And on Friday, I went to get my first physical therapy done. It freaking hurt, man. I was almost in tears. And but they loosened me up. I felt a lot better after that. But at first, it hurt like hell. Anyway, the point is I'm going to have a website solely for Roth IRAs. It's called RothIRAforNewbies.com. RothIRAforNewbies.com. Everything is going to be nothing but Roth IRAs on there. It'll be nothing else. Nothing, no climate change, no Social Security. It's going to be all Roth IRAs. RothIRAforNewbies.com. I got a couple articles on there already that I just repurposed from the site, my regular site, Heritage Wealth Planning. But this will be solely focused on Roth IRAs. So just keep that in the lookout. More to come on that for sure. All right, my man keeps telling me to lay off, dude. I get it, man. I love it, man. I get it. I'm not. I took a week's worth of perks, brother. That's it. I don't do it anymore, so I'm not going to. Just back in the net in the Pacific Northwest, watering the lawn on a beautiful Sunday evening. Thank you for your hard work and sharing. Not bad for an infantryman, for the Marine fan. Right on. Yeah, I just picked a bunch of potatoes out today. Freaking awesome. Awesome. I was a 70-30 split, bond at 70. Ooh, I realize now inflation will kill me, so I want to transition to 50-50. Should I dollar cost average, wait for the market, or just jump in? Like, just for me, just jump in and be done with it, and you'll move on. But the minute you do that, you know the market's going to go down. Don't blame me. You got to do what you got to do. If this is my money, just be done with it. The market's 5 weeks from now, 10 weeks from now, a year from now, 6 months from now, 6 years, you'll never remember what you did. It just won't matter. I can be optimistic because I'm a nobody. Enron, I was a WorldCom investor. I remember WorldCom. Bernie Ebbers, remember that guy? I think he died in jail too, just like Ken Lay. The prosecution of those Enron guys, other than I think it was Skilling, those other guys though, they freaking take lump sum on convention on pension. Barry says take lump sum on pension and convert. I don't know. That's way too tough for me to answer that. That's a good question, Barry. There's no way I can give an answer on that. It's way too many variables. How do you determine how much Roth conversion make each year? You can't. I mean, just the Medicare premiums. Just remember, basically, if you're 200,000 or more, roughly, you're going to be paying quadruple on. If married, filing jointly, dentist, you're going to be paying quadruple for that 1 year. Just keep that in the back of your mind. So if you're married, filing jointly, which I remember you being, so 200,000 is kind of your bogey. Now that does adjust for inflation, though. That's why Right Capital will never be able to know. Right Capital software doesn't say anything at all about the Medicare IRMA, the increases because of your adjusted income. It just doesn't. And I don't know any software that does. I'm sure there's something out there that does, but Right Capital won't. And so how much? I don't know. I think at the end of the day, say, look. Don't forget, it's just marginal tax rate too here. So if, let's say you're making $100,000, you're like, I don't know, I'm just using an example. 150 is still keeps you at 22%, but 151 puts you in 24%. If you convert 155,000, if you convert 55,000, so you're at the 24% bracket. Well, only 5,000 is being taxed at 24%. The other 50,000 is still being taxed at 22%. I think a lot of people get way too caught up in this, like, where they got to be right here to the dollar. If they go $1 above, they pay too much tax. It's not worth being that precise. I say, look, now the difference between 12 and 22 is pretty high. So you go over by a couple $1,000, you pay 22% tax on $1,000 that you went over. It's just, I don't think it's that big of a deal. The Medicare premium stuff is a bigger deal. So just keep it below, again, right now, I think this year is 180. Just keep it below 180 and you're good. But remember, it's the first, 180 still is only a 35% increase. So even if you go to 180, it's not like you're losing your house, but keep it below 180 to be on the safe side. You're fine. And again, that's marginal taxes. I mean, that's marginal adjusted gross income. So that's before your standard deduction. It's not taxable income. It's modified. That's what it is. Modified adjusted gross income before your standard deduction. So if you're at 100 and you convert 50, you're at 150. If you're at 100 and convert 100, you're at 200, which you've gone too far because it's not including standard deduction. I saw that, man. Thanks, Daniel. Appreciate it. We'll see if I can't get some time to track that down for sure. Yeah, ETFs always use Vanguard, Isaac. I just like Vanguard. Like people say, for me, it's just Vanguard or bust on ETFs without question. Buffering again. Damn, man. I haven't noticed it on my side. That's crazy. Yeah, more on single. My man Steve from Texas, more on single. I hear you, brother. I've done a lot. I got Scott's single. I did a bunch on him. I did Donna. I did Karen. All these people were single, but maybe I got a title. Well, I did Scott single. Maybe I got to title it differently. Ricky the trucker was married, but Donna, Karen, and Scott, they're all single. All right. Rob says, we do Roth conversion for 401k. Yeah, there's no 10% penalty on the Roth conversion, Rob. That's one of the exceptions on the rule for the 10% penalty. So Roth conversions are not subject to 10% penalty. Even if you're under the age of 59.5, they're just not subject to taxes, but not penalty. My man Bill says, I'm 60 and retired. Wife is 64 and getting Social Security. We have $350 in a 401k and $450 in cash. Should be converting to Roth. Yep. Okay, there you go. Getting free Obamacare for next 2 years. That's the drawback you're going to have. You're getting free Obamacare, man. So that's going back to another reason why you should not convert is if you're getting free Obamacare. That's you got to look at that, Bill, because once you go above that modified adjusted gross income, you don't get free Obamacare. I think it's like $60,000 or something like that before you lose your subsidy. So I just be careful because that's a benefit that you will lose, and I don't know if you'll ever make that up on tax-free money. I just don't know. So be careful. Bill Starbuck. I don't know who that guy is, Craig. Bill Starr. Is he a weightlifting guy? Because I love Ripito, my man Mark Ripito, and then Jonathan Sullivan up in Michigan, Rochester, Michigan, I think. Man, he's good stuff. But I appreciate it, Bill Starr. Make sure you do a trusted trust or company. 180. That's for today. I suspect that'd be more in 20 years for a. Yeah, right, Steve. It'll be much. But remember, that's for married people. They're going to account for inflation too. That's right, Steve. So going back to the Medicare premium increases, it is adjusted for inflation. Even though initially it wasn't. When it first became law, they did not adjust it for inflation, like they did not adjust taxation on Social Security either. No, I get it, man. We got lots of single people here. I guess what I was saying is defending myself, Quincy, about people saying you need to do more for single people. I said, man, I've done a lot for single people. I'm not against doing it. I did a lot. I just felt like, wait a second, I have done many. Scott, Karen, Donna, and others too, but we'll certainly throw more out there for sure. Steve says, still have issues knowing at what point I should stop doing Roth 401k versus traditional IRA. Traditional 401k. Yeah, man. Okay, right on. So that's foreign strength coach at different university powerlifter. Okay. Hey, Mary. I'm feeling okay, Mary. It comes and goes a little bit, the pain for sure, but I'm loosening it up a little bit, doing these exercises they're telling me. I'm going to see a physical therapist or actually an occupational therapist twice a week. And it hurt. It hurt when I went on Friday. It hurt bad. I was, she was like pulling my arm like this, and I was, oh yeah. It's funny. A guy from Saudi Arabia was an intern guy, and we're talking, and he was showing me pictures of the snow in Saudi Arabia with all these camels standing by around with snow pouring on camels. I just thought it was the funniest thing I've ever seen, snowing on camels. I said, you don't really have that many camels over there, and they said they have. Camels like we have deer here. Isn't that funny? I said, man, it's just the idea of just driving. He said people hit camels all the time. It's horrible for me. Like, damn, poor little camels. But I'm sure he's thinking it's horrible for him, us hitting Bambis and stuff. And we look, freaking deer, like overgrown rats here in Georgia. I'm thinking, man, camels. It's kind of like being up in Maine and moose. Moose are dastardly animals. But we're in Australia with kangaroos. It's just this crazy thing. I was like, it's camels, just hanging by, and there's a camel sitting on the side of the road. Get snow on them. And here's a problem with our immigration, by the way. So this guy comes to the U.S. He learns all the stuff about being a physical therapist. Then we got to send him back to Saudi Arabia. I'm like, that doesn't make any sense. I mean, I don't know if I have no idea what the circumstance, if they pay for him to come here or whatnot. But like, the dude wants to work here. He doesn't want to go back necessarily. Let him stay here. Why would we educate him here to send him back? It doesn't make sense. The whole thing is just insane. It's insane. So Quincy says, should you start Roth conversions before Social Security and possibly even pension? Unequivocally, yes, unless you get the Obamacare premium benefits. That's the one drawback, which I neglected to say earlier in this conversation. Steve, I'm not sure about the best time to do Roth versus traditional. It's a tough one, man, because you're single. It's tough. If you don't have a pension, I'd do Roth. I guess that was what it comes down to. If you don't have a pension, I would do Roth. If you have a pension, I'd probably do traditional, frankly. I went to healthcare.gov to play with the numbers to see how much I could do in order to get the subsidy. There you go. 2 things I really appreciate you speaking plain English. You don't make us feel stupid when we ask. Freaking Rob, that's dumb. Why you ask that question? Thanks, Rob. Appreciate it. I was just joking. That wasn't a dumb question. Does not the 2100 Act also just the limits the stat? Yeah, exactly. The 2100 Act, as it is at least proposed, will revisit the inflation adjustments on Social Security, which is a benefit to it. Yep. Hey, thanks, Harry. Right on. All right, cool. Try acupuncture. May help. Made tough to find in Georgia. Non-qualified 415 excess plan cannot be moved, changed. Lump sum. Right on, Bruce. Thumbs. We got 71 thumbs up. So if y'all haven't hit the thumbs up or the smash, do me a favor and do so. But I appreciate y'all doing that. And thanks to you guys, telling people to do the smash thing. Believe it or not, the smash actually helps. It again, I say this every single time. I'll probably say it till I'm dead. But the YouTube algorithm, it says who is being engaged. So you all being here, you all asking questions, you all watch time. It's not number of views with YouTube. And someone asked me at the beginning of this, I think it was Jerry, about starting a new YouTube channel. It's not views. YouTube could care less about views. YouTube cares about engagement. Thumbs up, the smash thing, comments, which is why even when, there's a guy named Big Red who says some silly stuff, and I say, hey, keep saying it, dude. It helps me with the engagement and also watch time. And so the reason why I'm starting to do these more, I enjoy the engagement, actually. I like this. I never thought I'd like it this much. I do. I like it a lot. I used to do seminars all the time. I love them. And I don't do them anymore, but this is similar like the seminar I used to do. But the watch time. So YouTube looks at engagement, activity, what we just talked about, and watch time. So the longer you watch, the more YouTube rewards me by its algorithm. And so what I tell my wife is just put the friggin' video on in the background, just to do autoplay, let it go. And then, the ads will pop up. Now I don't see the ads because I pay for the YouTube premium, $11.99, which means I can listen to it on my phone while it's not on. So what you'll see is off. If you're not paying the premium and you have it off, you can't listen to it in the background. But if you have the premium of $11.99, you don't get ads and you get to listen to it in the background. So I hardly even ever listen to podcasts anymore. I'm always on YouTube listening to stuff. So I like it. So anyway, that's how YouTube rewards you, is watch time and engagement. So just in the back of your mind, if you're wondering why everyone says smash and all that stuff, is because of that. Non-qual 415 excess plan and Vanguard SP 500 cannot be moved or changed. Lump sum payout cannot be changed. Yeah, take payout as market is or help hedge a year. Joe, I have no clue, brother. Sorry, man. I don't know. I would be insane to even entertain a guess on that. Sorry, man. Camel's legs are so long. The first point of impact bit the windshield. Yikes. Yeah, saw my video on 401k and taxes. Roth it mostly is Amigo one, Amero Amigo. Mostly is Roth IRA is again. You always want to default with a Roth, absolutely, until you can prove otherwise with evidence that it's not the best way to go. Not the other way around. The other way around again is default with deferrals until it's the other way to go. No. It's default with a Roth until you can tell yourself, well, there's why I should not do it. It's really important they do not have the funds. Thanks, Josh. I'll wait until I'm off Obamacare. Yeah, I agree with that, Bill. I think I watch your videos to the end much more than many people I watch on YouTube. Thanks, Mike. That's fantastic. New book status. Man, dude, Rick, thanks for asking. New book. I think I'll have that sucker pretty much done by this week. So if you're on my subscribe star, I'm going to send you, I'm paying these folks to do the design of my cover. So I'm going to ask for your input and for the subscribe star folks who I have, what you think is the better of the covers I'll get. I'll probably get a bunch. So I'm looking forward to that. And I'll share those with you. And then once we narrow it down to say 3, I'll probably share it with a general YouTube audience as a whole as well. for the top 3 or the choices that you all have on the cover. The cover is incredibly important. But I'm pretty much done with it. I'm looking at, I had it open this, I look at it a couple hours every morning, read it out loud. Now, what I'll also probably do is I'll probably do just videos one after the other on the book, so it helps me read it out loud and just post it up there. Then y'all can see it and comment on it as you like. It'd be great. But I do plan on having it out here, like literally within, I don't know if I'll have the actual book out within the week, but I'll have it being sent to Amazon. It's not hard to do at Amazon Book, man. It's not that hard to do, but the end of the week might be a little bit too aggressive, but that's my intention. I mean, I'm literally almost done with it. I'm done with everything, writing it. Now it's just editing it, making it prettied up and whatnot. And it's a ton. I mean, I went insane. It's not a huge long book. It's 80 pages, 20,000 words or something like that. But I went insane in terms of research. It was, way more than I anticipated. I couldn't stop. It's freaking like, smoking crack. I just couldn't stop. And I've never smoked crack, so I have no idea what it's like. But, I don't know if you smoke crack. I have no idea. But it's just, I couldn't stop. It was awesome. So I'm very much looking forward to it. Just order webcam because I've yeah, there you go. I agree. Jerry, start a freaking channel, man. Just remember, no one's going to watch. No one's going to watch for the first 3 months. It's okay. If any of y'all were looking at doing a YouTube channel, my guy was Miles Beckler, Beckler, Miles Beckler. He was my mentor. He didn't know me maybe might know me in terms of, I commented on his videos a lot, but Miles he just told it like it is. And he says, you don't need these gurus. The guy's just freaking awesome. So if you're looking at starting a YouTube channel, look at Miles Beckler. He started his back in the end of 2016, and now he's got over 100,000 subscribers, just doing all things on Facebook ads, YouTube's. It's great. In fact, he sent out a thing today, an email. I'm on his email list, and he said it was interesting. He said, how long does it take to make it? And I guess I already deleted it. But he said, it took the top 10 billionaires in America on average 8 years before they made their first million. And I thought that was very interesting because, a lot of these people on YouTube are get rich quick schemes. And yet Phil Knight didn't get rich quick. Warren Buffett, I don't know, actually. He didn't say. He mentioned Phil Knight specifically. He mentioned somebody else took like 16. I can't remember. But it was incredibly interesting. So I'm a huge fan of Miles Beckler. He's a good guy. I love what he does. So, Jerry, I'd look at Miles, watch his stuff because he'll tell you, and he'll tell you what you got to do, and just follow what Miles says, and you'll be successful. Just because it's just about putting out content and not getting so focused on the stupid stuff. Like, I got to make the best images. No one cares about that. They just care about the content. Also, too, I'd say be a little bit entertaining. And what I mean by that is, in my field, some of these guys are just dull. I'm like, oh gosh, could you literally please stop. I'm going to jump off a bridge after I slice my wrist, and I'm going to jump in a bridge in a water full of hungry sharks because I can't take it anymore. I don't understand. Like, I like that guy Big Al from I think it's Pure Financial. Big Al and some guy named Joe. I like them. They're entertaining. But a lot of the guys, and it's just they got their suit and tie on. And I used to wear a tie when I first started doing this because I thought that's what everyone wanted. And I said, I don't want to do this anymore. But anyway. All right, what else we got? Another Saturday night, want to help your algorithm, so I'm just aimlessly. Thanks, man. Right on. Clarify. I don't have any knowledge with CPA in California, Craig. Sorry, man. I don't. Converting IRAs to Roth, but then your tax. Yeah, the tax torpedo is when you have Social Security and other income taxes that you have, is that it makes your Social Security subject to tax on top of your other income. So essentially every dollar extra of income is $1.85 of taxable income, Mike. And that's a tax torpedo. It's freaking insane. And so what happens is when people are in that lower tax bracket and they have Social Security, that's fine. But when they start doing 401k distributions on top of their Social Security, That just means, again, they're going to have $1.85 taxable income for every $1 of 401k distributions, because they're adding taxes on the 401k, but now they're making what previously was not taxable Social Security income taxable. It's a double taxation. That's how it works. It's freaking insane. On live, nah, it's not the like button. It's the smash, Isaac. The thumbs up thing. The thumbs up and the like button are the same thing. Enjoy the video on a reverse mortgage. Yeah, exactly, Rich. It friggin' ticks me off. All these people, look, you can gripe on reverse mortgages because they're expensive. I can get that, but don't gripe on them as if you're going to lose your house because of it if you didn't pay your property tax. The reverse mortgage isn't what causes your house to be foreclosed or repossessed or have the county put you out. It's the lack of paying property taxes. It flummoxes me. I don't understand it. I don't understand when people make a connection that inherently is not there. They're not paying your property tax. Forget reverse mortgage, forgetting a second mortgage, forgetting your first. I don't care what kind of lien or a debt you have on your home. If you have none, don't pay your property tax and see what happens. Don't keep up your house and see if the county doesn't come knocking. I'm telling you right now, they're gonna. The reverse mortgage has nothing to do with it. I don't get it, Rich. And so many people say reverse mortgage, they got their house taken away because they forgot to pay the property tax. I'm like, the reverse mortgage had nothing to do with it. It's freaking crazy. Maximum amount Roth, 401k and Roth IRA. Do I recommend taxable Vanguard brokerage account? Yeah, oh yeah. Again, for me, I'd be doing, if I have anything, and just for me, not for you, just for old buddy Josh, if I have a taxable brokerage account, I want that sucker to give me as least amount of income, be long-term capital gains. And again, ETF should not do that anyway, but no dividends either. I don't want anything taxable. I want it to be growth and growth only. So small cap growth or large cap growth, fine. But anything on the growth side of the growth value spectrum is probably where you're going to be better off. Obviously, it's more aggressive, more risk, but from a tax perspective, in fact, I don't even know if I would argue that growth funds are not more risky. I would argue value funds are riskier. That's why they're value, because their price is so far knocked down. There's a reason for that, but we'll save that debate for another day. I'd say growth and an ETF, a Vanguard, let that sucker run, never touch it, and you're good to go. Jerry, my chair will be about promoting me. Oh boy, no one's going to watch that, and you'll get nothing but thumbs down. But you'll get a lot of comments, or not comments, a lot of activity. I got my 18-year-old convinced I'm putting 10% of her first job income into a Roth. Can you imagine the leg up? Oh, dude. Can you imagine 18-year-old putting 10% of her income into a Roth, Mike? Here's Tina K. Paso. She is gonna be setting the world on fire, man. Mike, I convinced a coworker a few years ago to fund Roth. He now has 100,000. That's freaking awesome. That's awesome. Love these live Q&A. We're doing them every week, Rhonda. Every Sunday at 8 o'clock, we'll be doing these. Now that hockey is over, I can do it. Indonesian, right on. Gilang and Garrett, right on. Bernie Sanders will say them, Josh. And Texas is in the house. Yeah. Okay, there you go. Right on. Mike says Warren Buffett didn't make his first million until he's in his 30s. Exactly. That's exactly right. Look, I got 101 thumbs up. Freaking awesome. All right, buddy of mine, half a dozen whitetail buckheads mounted as he doesn't hunt. All 6 were hit. Overgrown rats. That's crazy. Yeah, right on. I think Sunday. That's what I've been meaning to do. So I tried to do it last time. YouTube is getting rid of, or Google, the Google Hangout. So what I was trying to do was for the folks who it doesn't have to be the folks. I was trying to do webinars where I could show you the Right Capital software, how I use it for like 5 weeks or 6 weeks on Thursdays. But because they don't do Google Hangouts anymore, there's no way that I've been able to tell where I can show my screen share on YouTube. And I couldn't figure out how to do it. So what I'm going to start doing, I'll probably buy this thing called Zoom, which you can start doing yeah, that's right, freaking football. I tell you, Rob, I just don't follow that much anymore, man. It's weird. It's weird. Man, back in the day, it's crazy. I mean, I watch everything. Now I hardly watch any sports at all. I don't even watch hockey except for the playoffs. And then and that's it. It's nuts. I don't watch hardly any. I did watch the AAF. I like the American Alliance of Football, Alliance of American Football. I did like that. I will watch the XFL as well. What is before the kneeling thing? It's a peppermint tea. Yeah, I had dark roast Walmart for coffee, Dana, but peppermint tea for night. The kneeling thing, it pissed me off. I just said, well, come on. I mean, it's stupid. But it's before that. I just started getting bored, man. I don't know what it was with football. It just started boring me. I don't know if I just got older or what. But actually, when the Patriots lost the second time, the Giants was really what that didn't bore me. That just hurt me. It's weird. And people say it's just a game. It's not just a game. It's not. It's just strange. For me, it wasn't. And I said, I don't like the way I feel about this anymore. I feel going back to Richard Thayer, who won the Nobel Prize for Behavioral Economics, and going back to Daniel Kahneman, who won the Nobel Prize for you hate losing twice as much as you love winning. When the Wes Welker dropped the line, he said he would have made that catch 100 times out of 100. Oh, that was painful. But then going back to those when the Patriots lost, it felt so much worse than when we beat the Rams. That was pretty boring, but we still won. I was glad when we beat the Falcons. You notice how I said we because I was there. When we beat the Panthers, when we beat the Eagles, when we beat the Rams. Who else we beat? We beat one other team. I forgot. But anyway, when we Panthers, Eagles, Rams, Panthers, Eagles, Falcons, Rams again. And I forgot. Anyway, Panthers. I forgot. We won 6. Who the hell did we beat? Okay, I forgot. But anyway, it's so much more painful. So much more painful. So I just stopped watching. But anyway, yeah. No, Attorney General Barr was on the pipes. Oh, man. Seahawks. Yeah, that's right. That's right. Oh man, that's fantastic. That was fantastic. No, I wasn't at the Super Bowl. Hell no, man. I wasn't there. Seahawks. Yeah. Oh yeah, that's right. So I got. So what I'm going to do is I'm going to start doing this thing on Right Capital, and I'm going to buy this thing called Zoom, where I can do webinars, and I'll start doing that on Thursday nights. So I'll be probably button up against football and button up against, I guess, football Sunday nights and Thursday nights. So the reason football is on Sunday and Thursday nights is because that's what most people are watching. So that's what I'm going to do it as well. We'll see. We'll see how it shakes out. I'm doing a class on. I'm going to do a course I'm going to offer, Rick. I was hoping it'd be out by the end of July, but I don't think it will be. It's going to be a course where I just show you everything from financial planning 101, everything. I'll just put it online. People could pay me. I won't be on that. It'll be just videos essentially where I show you what to do. Look at 1040s, look at trust document, you name it, it'll be on there. From everything from the simplest to more complex, just be video after video after video. And we'll probably do at some point live videos to answer questions, stuff like that. But we'll see. We'll see. I can't do it until this is off. High percentage gets sold through 4 home or pass away. Yeah. It's something like a Udemy course. I think it's not Udemy though. It's I forgot what the name of it was. I forgot off the top of my head. All right, my friends, that's a 2-hour mark, but I appreciate y'all being here again, man. I just again, it's fantastic. Thanks, guys. I can't remember the name of the course, Steve. It's driving me crazy. I'm getting old. All right, gonna hit the sack. We'll see you guys. Thanks again for being here, and stay tuned for the video I do on a couple on singles and what we did for my man Harry about doing a 10-year period certain annuity. We'll see you guys later. Thanks, guys.